Now let's take a look at the bigger picture. Robert Schein's with us, Chief Investment Officer at Blanke Schein Wealth Management. Thank you for being with us, Robert. Your thoughts? We've gotten in a lot of inflation data this week, earnings. It's been mixed back and forth, but how are you feeling?
Well, markets, specifically the bond market, obviously a lot of volatility the last couple of weeks. The 10-year is something to take note of that we're seeing, as well as corporate earnings. And let's just start with corporate earnings. Over 90% have reported for the second quarter 2023, and that was better than expected. The key takeaway is resiliency in balance sheets, which is sort of the sigh of relief that the market was looking for. However, the bond market, the 10-year treasury now is above the 409 level. And what that's telling us is that interest rates could be moving higher in the foreseeable future.
Yeah, I see it right now, 416. I almost have to rub my eyes as you see rates rising. I mean, I don't know. When you see the inflows into bonds, everybody's been putting their money to work there. I mean, why not, right? I mean, what do you tell folks when they're trying to figure out what to do in this kind of environment, where to invest?
Yeah, so on the short term, we've had a lot of treasuries come due, so we're just rolling treasuries and extending them out on the yield curve as rates rise. We believe we've been anticipating, saying to clients all this year, we could see the 10-year go to 5%, sort of the 493, not to get too technical, but clearly the 10-year is telling us that the Federal Reserve potentially could raise, the 12th time, and that could be sort of the opportunity to extend on the yield curve. So, ultimately, if you have maturities coming due, start looking at some opportunities to extend on the yield curve because you're getting, 5-6% right now. And you want to lock that in because who knows what 2024 is going to actually, hold on the horizon for the economy in corporate America.
Well, that's the whole thing. What do you think will drive this market? I mean, overall, I know you're watching inflation. Tell me more about investors and what they should be focusing on between now and the end of the year.
Again, this is not a set it and forget it market. In fact, if you saw last few months, since the July CPI report reading, which was the June reading, we saw a market shift. So if you just have an autopilot on your 401k or your retirement account or even just your investment account, and you thought technology is going to take you, the next 6 months moving forward, you're not doing well as you could have because it's all about rebalancing. By that, I mean energy is now the leader and it's providing a lot of value. If you look at the energy sector, over 100% of the stocks in the energy sector are above their 200-day moving average. Again, another technical sort of buying signal. So we've reallocated to energy. We still like technology, but it's one of those it's not a set it, forget it. It's being proactive and sort of pick and choose sectors that will be sort of the next leg up in the markets as markets sort of broaden out and play catch up as we're seeing.
Right. And in the big picture, I mean, when you think about equities, I mean, what do you tell folks about equities? I mentioned treasuries, and you talked about some of the investments people are making. We saw 206 billion inflows into treasuries, which obviously has been a record. What about equities? I mean, is there opportunity there when you're sort of putting a portfolio together, maybe for a longer term portfolio?
Yeah, Nicole, there are a lot of opportunities out there, and a lot of the flows that you just pointed out in the treasuries are actually in the 20-year, believe it or not. They're not wrong right now. They're just early, but we believe later on, longer on the yield curve on the treasury market for sure. But specifically in equities, again, look at healthcare, look at financials, and then look at energy because those sectors have to play catch up. So you want to broaden and rebalance your portfolio, make certain that you're being proactive. These are great markets. Companies that will win out, whether we hit a recession or not, are companies that have cash on the balance sheet that will work their way to basically top line and bottom line performance in the foreseeable future. So this is a great time to be proactive and pay attention because there's a great opportunity right now for the next 6-12 months.
On the other side of the coin, is there anything that you might stay away from?
Yeah, utilities aren't looking good, and a few other, sectors right now where inside technology, the small caps are going to sort of weather the storm not as great as large caps. Let's say if we do have a recession across the spectrum. So there are some spots where you want to pick and choose. So right now, utilities aren't looking so good. So I would just avoid that. And then look at markets that are trending and sectors that are trending positively in the short term and look at that.
Yeah, how about abroad? I mean, our own Jeff Kleintop from Charles Schwab was talking about Europe and the inflation picture just being a better picture than here at home, because here at home we still have a housing issue where shelter is still very hot running, and that the European picture looked a little better when it came to that. He actually was talking about investing abroad.
We love it. There are, again, like everything, there are some opportunities in Europe. Some great countries that have, some exposure to, we believe, that even though the dollar is sort of rising, it's been bouncing around this year, we believe the dollar could be falling once the Federal Reserve starts easing, let's say in 2024. If that happens, you're going to want to look at emerging markets. You're going to also want to look at international. So if you don't have international exposure for investors, put some international exposure in there. Broad diversification is always advisable, and then start legging in or dollar cost averaging as we see sort of the economics play out of sort of where the dollar goes. But there's a lot of, if you look at just the PE ratios, that's a very, in Europe in general across the board, there are a lot of values to be had versus the S&P PE, which is like a 19.
Right, understood. Thank you so much. Robert Schein, Blanke Schein Wealth Management. Really appreciate it.
Have a great weekend.